They tell you buying a car is freedom, independence, the American dream on four wheels. But for tens of millions of people, that dream is debt on wheels. You don't buy cars in America. You rent debt on wheels. Because the car sitting in your driveway doesn't really belong to you, it belongs to the bank. And the system that sold it to you? It was never built to help you drive. It was built to keep you paying. Before we start, drop your state in the comments. How long is your car loan? 60 months? 72? 84? Have you ever traded in a car while you still owed on it? You're not alone. Almost no one finishes paying off their car before they need another one. This is educational content, not legal or financial advice. Auto lending laws vary by state. Always verify your specific rights before taking action or signing new contracts. For decades, car ownership was simple. You saved, you bought, you drove, the car was yours. But somewhere along the line, ownership got replaced by financing. Now, almost 9 out of 10 new cars in America are bought with loans, and the average car payment has quietly climbed past $750 a month. For new cars, it's often over $900. That's not a car payment. That's rent. Except with rent, you can leave when the lease ends. With a car loan, you're locked in for years, paying interest on a depreciating asset that loses value every single day while your debt stays exactly the same. They call it affordable financing. They tell you, you deserve a new car. They show you commercials with families smiling in shiny SUVs, driving through mountains, living their best lives. But look closely at what they're really selling. Debt disguised as mobility. A trap disguised as convenience. A lifetime subscription disguised as ownership. Dealers know that most people don't walk in asking, how much does this $45,000 SUV cost? They walk in asking, how much is the monthly payment? And that one question gives the entire game away. Because once you start thinking in monthly payments instead of total cost, you've already lost. The dealer knows it. The finance manager knows it. They will use that against you for the next 2 hours. Here's how it actually works when you walk into a dealership. You sit down. The salesperson smiles. They ask what you do for a living, whether you have kids, what kind of car you're looking for. It feels friendly, conversational. But everything you say is being used to calculate how much they can extract from you. You mention you can afford $600 a month, maybe $650 if you stretch it. Now watch what happens. They don't negotiate the price of the car. They don't talk about the interest rate. They don't discuss the total amount you'll pay over the life of the loan. They negotiate the length of the loan. 5 years? Too high. 7 years? Getting closer. 8 years? Perfect. Now the monthly payment fits your budget. But here's what they're not telling you. A 72-month loan doesn't mean more flexibility. It means 6 years of payments on a car that starts losing value the moment you drive it off the lot. An 84-month loan means 7 years of paying interest on an asset that will be worth a fraction of what you owe long before you're done paying for it. Your car begins depreciating immediately, 20% in the first year. By year 3, it's lost 40% of its value. By year 5, 60%. But the debt? That doesn't depreciate at all. It stays exactly where it is, compounding with interest every single month. So by the time you're 3 years into a 7-year loan, your car might be worth $15,000, but you still owe $20,000. That's called being underwater or upside down on your loan. That's where millions of Americans live right now, driving cars worth significantly less than what they owe on them. Let me show you the math they don't want you to see. The math box. Car price, $35,000. After $2,000 down, financing $33,000. Interest rate, 7% for 72 months. Monthly payment, $563. Total cost, $40,536. Interest paid, $7,536. Over 6 years, you'll pay $40,536 total. That's $7,536 in interest alone, on top of the $35,000 purchase price. You paid over $42,000 for a car that's now worth maybe $14,000 if you're lucky. Here's the part that breaks people. After 3 years of payments, 36 months of $563, which is over $20,000 you've paid, you still owe about $18,500 on the loan. But your car is only worth around $21,000 at that point if it held value well. So you've paid $20,000 and you have maybe $20,500 in equity. That's it. That's what you actually own after 3 years of payments. Now extend that to an 84-month loan at 9% interest because your credit isn't perfect. Same $35,000 car. Now you're paying $47,286 total over 7 years. You've paid $12,000 in interest. After 4 years of payments, your car is worth less than half what you owe. That's how it works. That's why the average American with a car loan will never actually own their car before they need to replace it. Here's the hidden trick the industry doesn't want you to know, the one that keeps this cycle running forever. When you go to trade in that car you're still paying for, the dealer doesn't make your old debt disappear. They don't pay it off and start fresh. They roll it into your new loan. You owed $5,000 more than your car was worth? No problem. They just add that $5,000 to your new loan balance. They call it negative equity rollover. You call it a fresh start. But what it really is? It's refinancing your past mistake into your future. You walk out of that dealership feeling good. You got a brand new car. You didn't have to come up with any money down. The monthly payment is only slightly higher than what you were already paying. But now you're paying interest on your old car and your new car at the same time. You're financing a vehicle you no longer own, along with a vehicle you don't own yet. Within 2 years, you're right back where you started. Underwater again, owing more than the car is worth, trapped in a cycle that only ends when you stop playing the game. That's how people end up owing $45,000 on a car worth $30,000, or $60,000 on a truck worth $35,000. That's how families pay $80,000 total over a decade for vehicles that should have cost $40,000. This isn't a bug in the system. This isn't an unfortunate side effect. This is the business model, keeping you in debt, keeping you trading in early, keeping you rolling over negative equity loan after loan after loan. A mechanic in Ohio bought a used truck for $28,000 5 years ago, financed the full amount at 11% for 72 months because his credit wasn't great. 3 years in, the truck needed major repairs, transmission issues, engine problems. He couldn't afford to fix it and keep making payments, so he traded it in. Still owed $16,000. The truck was worth $9,000. He rolled over $7,000 in negative equity into a $32,000 loan for a newer used truck. Now he owes $39,000 at 13% interest because his credit got worse after missing payments on the first loan. His monthly payment went from $450 to $680. He's still 7 years from owning anything. That's not irresponsibility. That's a system designed to trap people who need transportation to survive. But let's talk about how the trap really makes money, because the sticker price of the car is just the beginning. Dealers make huge profits not from selling cars, but from selling the financing. The car is the bait. The loan is where the real money is. Every loan application you fill out gets sent to multiple lenders, banks, credit unions, captive finance companies owned by the car manufacturers. They compete to approve you, but not for your benefit. Here's how it works. If the lender approves you at 8% interest, the dealer is allowed to mark that up. They might tell you your rate is 10%. That 2% difference? That's called dealer reserve or rate markup. It's pure profit, built directly on your ignorance of what you actually qualified for. In many states, there's no legal limit on how much they can mark up your rate. They can add 2%, 3%, even 4% to your interest rate and pocket the difference. You'll never know unless you specifically ask, what was the buy rate from the lender? Most people don't even know that question exists. On a $30,000 loan over 6 years, a 2% markup means an extra $1,900 from your pocket goes to the dealer. You think you're paying the bank? You're paying the dealership for the privilege of borrowing from the bank. Then come the add-ons, the extras, the things they say you need to protect your investment. Gap insurance, which covers the gap between what you owe and what the car is worth if it's totaled. Sounds smart, right? Except they're charging you $800 to $1,200 for something your own insurance company would sell you for $200 to $300. They're financing it into your loan, so you're paying interest on insurance for 7 years. Extended warranties. Sounds good in theory, but the average extended warranty costs $2,000 to $3,000, covers almost nothing useful, and is nearly impossible to actually use when something breaks because of all the exclusions and requirements. Paint protection, fabric protection, tire and wheel coverage, anti-theft etching, where they literally etch your VIN on the windows and charge you $400 for something that costs them $10 and does absolutely nothing to prevent theft. Each one added to your loan. Each one growing with interest over the life of the loan. What was once a $30,000 car becomes a $36,000 loan before you even leave the lot. You think you're protected. You think you made smart choices, but really, you just financed another pile of dealer profit. The industry calls this full spectrum lending. What it really means is, we'll find a way to approve anyone, no matter how broke they are, because we make money whether you pay or not. They don't care if you default. They've already built the profit into the structure. They've already sold your loan to an investor. They've already made their dealer reserve, their finance fees, their add-on commissions. By the time you drive away, they've won. In 2024, the average interest rate for a subprime borrower, someone with credit below 620, was over 14% for a used car loan. Some contracts hit 20%. Some go as high as 25% or even 29% for the worst credit or the most predatory lenders. That's not auto lending. That's payday loan territory. Except this time, your collateral isn't your next paycheck. It's your car. The thing you need to get to work, to take your kids to school, to live your life. When you miss a few payments, the repossession process starts instantly. They don't need to take you to court. They don't even have to warn you anymore in most cases. Most modern cars, manufactured after 2015, have GPS tracking built in. Many have remote start-disable systems. A lender can lock your car remotely in your own driveway with a single click from a computer. They call it a starter interrupt device or a kill switch. One missed payment and your car won't start. 2 missed payments and the GPS tells them exactly where your car is. 3 missed payments and they send a tow truck in the middle of the night. You wake up and your car is gone. No warning, no court order, no chance to catch up. They can find it, tow it, and auction it off, all without ever seeing you face to face. You lose the car. You lose all the money you've already paid. Thousands, maybe tens of thousands of dollars gone. You lose your credit score. Here's the kicker. You still owe the balance after they sell the car at auction, because the auction price almost never covers what you owe. A car you owed $18,000 on gets auctioned for $9,000. They subtract their repo fees, storage fees, auction fees, legal fees, maybe another $2,000. Now they apply $7,000 to your balance. You still owe $11,000. On a car you no longer have. You lose your ride. You keep the debt. They move on to the next person. But here's the part almost no one talks about, the part that should terrify anyone paying attention. Auto lending isn't just about individual borrowers anymore. It's an entire $1.6 trillion market that's quietly becoming what the mortgage market was in 2006. Banks and lenders learned something from the housing crash of 2008. They learned they can't always count on people buying houses. Housing is expensive, complicated, requires good credit and down payments. But cars? Everyone needs a car. Especially in America, where public transportation is practically non-existent outside of a few major cities. So they took the same formula that created the mortgage crisis: long terms, loose underwriting, high fees, predatory rates, borrowers who can't really afford what they're signing, and applied it to auto loans. When risk is sold upstream and profit is taken upfront, your default is a line item, not a lesson. Today, lenders bundle those loans into securities called auto loan-backed securities, or ABS. They take thousands of car loans, slice them up, package them together, and sell them to investors around the world. Pension funds, hedge funds, insurance companies. It's the exact same playbook as the mortgage crisis. Subprime mortgages became mortgage-backed securities and nearly destroyed the global economy. Now subprime auto loans are being packaged and sold the same way. Except this time, it's not homes on the line. It's the cars millions of Americans depend on to work, to survive, to function in a society with no real alternatives. Default rates are climbing. Subprime auto loan delinquencies hit record highs in 2023 and continued rising in 2024. More people are falling behind on payments than at any point since the last recession. But the system keeps running because the people who designed it don't lose when you default. They've already sold your loan to someone else. They've already made their fees. They've already moved your risk off their books and onto some pension fund in Europe or Asia that bought a bundle of auto debt thinking it was a safe investment. When those securities start failing, when the defaults pile up, when the whole structure starts to crack, it won't be the banks that suffer. It'll be you. It'll be the workers whose pension funds collapse. It'll be the economy that crashes again while the people who built the system walk away with their bonuses intact. Who's most at risk in all of this? The same people always are: working-class families, people with low credit, people with few options, people living in places where not having a car isn't just an inconvenience, it's a death sentence for your ability to earn a living. Communities where public transportation barely exists. Rural areas, suburbs built around highways. Places where everything, your job, your grocery store, your doctor, your kids' school, requires a car to access. In those communities, dealers know they can sell anything. Because not having a car means not having a job. Not having a job means not being able to feed your family. So people sign. Not because they're stupid, not because they're irresponsible, but because the alternative is worse. These dealers aren't in the business of helping people drive. They're in the business of trapping people in rolling debt, a cycle of repossession, reapplication, reapproval, and resale. The same cars get financed and repossessed over and over again. A dealership repossesses your car, auctions it, another dealer buys it, marks it up, finances it to someone else at a predatory rate, repossesses it again 6 months later, and repeats the cycle, each time creating another wave of profit. That's not transportation. That's extraction, an industry built on desperation and sustained by the myth that car ownership is still achievable for working people in America. Let's talk about the emotional cost of all this, because the numbers only tell part of the story. When your car is your lifeline, your way to work, to school, to daycare, to the grocery store, to the doctor, every single payment carries fear. Fear of missing one. Fear of the repo truck showing up at 3 a.m. Fear of being stranded with no way to get to the job you need to pay for the car you need to get to the job. That fear is the product. That anxiety is what keeps the system running. Because the moment you're scared, you'll pay anything. You'll refinance at a worse rate just to lower the payment. You'll roll over negative equity. You'll sign papers you don't fully understand. You'll agree to terms you know are bad because the alternative, losing your car and everything that depends on it, is unthinkable. The banks know it. The dealers know it. They're counting on it. The auto loan industry thrives on that anxiety the same way payday lenders thrive on desperation. Different product, different audience, same trap, same psychology, same exploitation of people who are just trying to survive. Drop a yep in the comments if you've ever made a car payment while skipping something else you needed. Groceries, medicine, rent, because losing the car felt like losing everything. Here's the reality most people don't see until it's too late. When you buy a new car with a 7-year loan, it's not a purchase. It's a subscription. You're renting from the bank. You're paying for the illusion of ownership. You don't own that car, not until the last payment clears. By then, 7 years later, it's already falling apart. It's worth half what you paid. It's ready to be traded in for a new round of debt because now it needs repairs you can't afford, and the cycle starts over. That's not progress. That's not building wealth. That's not achieving the American dream. That's planned dependency. A treadmill built out of steel, glass, and paperwork. The only way off that treadmill is to stop running. So what can you actually do? How do you avoid this trap or get out if you're already in it? First, never, ever shop by monthly payment. That's how they control you. That's how they stretch the loan to 7 years and charge you an extra $10,000 in interest without you noticing. Shop by total cost. Shop by out-the-door price. If a salesperson starts talking about, "We can make the payment work for you," stop them immediately and say, "I don't care about the monthly payment. What's the total price of this car, including all fees, before financing?" Make them give you a number. Write it down. Then calculate what you'll actually pay over the life of the loan with interest. That's your real cost. Second, get pre-approved for a loan with a bank or credit union before you walk into a dealership. This one move flips the entire power dynamic. Now, you're not asking the dealer for financing. You're coming in with your own financing already arranged. You know your rate. You know your terms. You know what you qualify for. The dealer can't mark up your rate because you're not using their financing. They can't manipulate the loan term because you've already set it. They can't add dealer reserve because you already have a lender. Credit unions almost always offer better rates than dealership financing, especially for people with average or below average credit. Sometimes 2 to 4% better. On a $30,000 loan over 5 years, that's $3,000 to $5,000 in savings. Walk in with a pre-approval letter. Tell them, "I have my own financing at X%. If you can beat that rate, I'll consider your financing. If not, I'm using my own." Ask for the lender's buy rate in writing. That's the rate the lender actually offered before any dealer markup. If they refuse to show you, that tells you everything you need to know. You just took away their biggest profit center. Third, skip the add-ons. All of them. Gap insurance, paint protection, extended warranties, fabric protection, tire coverage, anti-theft etching. 90% of the time, these are overpriced garbage that benefit the dealer, not you. If you genuinely want gap insurance, buy it from your car insurance company directly. It'll cost a fraction of what the dealer charges, and you won't be paying interest on it for 7 years. Extended warranties almost never pay out what they cost. The exclusions are so extensive that by the time something actually breaks, it's not covered, or the deductible is so high it's not worth filing a claim. Just say no to all of it. I'm not interested in any add-ons. I just want the car and the financing. They'll push. They'll make you feel like you're making a mistake. They'll tell you stories about people who regretted not buying the warranty. Ignore them. Say no. Move on. Fourth, understand the trade-in trap and avoid it at all costs. If you owe more than your car is worth, do not trade it in. I know that sounds impossible. I know you need a different car. But rolling over negative equity is how people stay trapped in this cycle for decades. Instead, do one of two things. Either keep the car and pay down the loan until you're no longer underwater, or sell it privately and cover the difference out of pocket if you can. Selling a car privately almost always gets you more money than a dealer trade-in. The dealer is trying to make a profit on your trade-in when they resell it, so they'll lowball you. A private buyer is just trying to get a car, so they'll pay closer to actual market value. If you owe $15,000 and your car is worth $13,000 privately, you need to come up with $2,000 to pay off the loan when you sell it. That's hard. That's painful. But it's better than rolling that $2,000 into a new $30,000 loan and paying interest on it for 7 more years. Fifth, if you're already stuck in an upside-down loan, don't panic. You have options. Refinancing through a credit union can sometimes lower your rate dramatically, even if you're underwater. If you're paying 12% through a dealership and you can refinance to 6% through a credit union, that cuts your monthly payment significantly and saves you thousands over the life of the loan. Even if you have to extend the term slightly to make the payment manageable, getting a lower interest rate can be worth it. You're not making the problem worse if you're cutting your interest rate in half. Another option, make extra payments toward the principal whenever possible, even if it's just $50 or $100 extra per month. Specify that the extra payment goes to principal, not just the next month's payment. This cuts years off your loan and thousands in interest. If you've already been repossessed, you still have rights. Lenders are required to notify you before they auction your car. In most states, you have the right to redeem the car by paying off the full balance plus repo fees before the auction. Or you can demand an itemized breakdown of all fees and challenge anything that looks unreasonable. Many states have strict laws about how repos can be conducted. If they broke any rules, entered your garage without permission, breached the peace, failed to provide proper notice, you can fight it. Don't let them intimidate you into silence. Let's zoom out one more time. Because this isn't really about cars. It's about the illusion of choice in a system where debt is the default setting for everything. They tell you you're free because you can buy anything on credit. You can drive a $50,000 truck even if you make $35,000 a year. You can have the newest model, the best features, the lifestyle you see in commercials, all for just $800 a month for the next 7 years. But real freedom doesn't come from owning things that own you back. Real freedom is not having a $750 monthly car payment hanging over your head. Real freedom is not waking up terrified that one missed payment will destroy everything. Real freedom is owning your car outright and never having to think about a lender again. Every time you sign a new 84-month loan, the system wins. Every time you ask for a smaller monthly payment instead of a lower total price, the system wins. Every time you trade in early, roll over debt, or finance the add-ons, the system wins. Because the goal was never for you to own the car. The goal is for you to keep making payments, to stay in the cycle, to be a reliable revenue stream for banks and dealerships and investors who've never seen your face and never will. If you're in that cycle right now, if you're 3 years into a 7-year loan, underwater, exhausted, wondering how you'll ever escape, stop blaming yourself. You didn't fail the system. The system was designed to fail you. You were never supposed to pay off that loan. You were supposed to keep paying just long enough to feel desperate enough to trade it in and start over. But you can break the cycle. You can stop measuring your worth by the badge on your hood or the year on your registration. You can choose to drive an older car that's fully paid off instead of a new one that owns you. You can choose peace over payments. You can choose ownership over the illusion of ownership. The dealers won't tell you that. The banks won't either. But every time someone refuses another 84-month loan, every time someone pays cash for an older car instead of financing new, every time someone shares how this system really works, the trap gets weaker. So drop your state in the comments. How long is your car loan? How much did you roll over from your last one? Have you ever been repossessed? Have you ever escaped the cycle and finally owned a car outright? Tell your story. Because someone watching this right now is about to walk into a dealership and sign a loan they'll regret for 7 years. Your comment might be what stops them. Your story might be what saves them from years of payments and stress. If this video opened your eyes, if it made you rethink that great deal you thought you were getting, if it made you realize this isn't about personal failure, share it. Send it to a friend who's shopping for a new car. Post it where people who are about to sign can see it. Because the auto loan industry survives on silence, on confusion, on people thinking this is just how buying a car works. But now you know better. Now you see the trap. Now you understand the game. Stop playing their game. You don't need a new car to feel free. You just need to stop paying for someone else's profit. The bank will own you until you decide it doesn't.